Opening hook. Imagine a single entity whose influence quietly permeates nearly every facet of your daily life. The stock you own, the retirement fund that secures your future, the coffee you drink, the technology you use, even the housing market in your city. This isn't a shadowy cabal from a spy novel. It's a real-world behemoth whose name, while familiar on Wall Street, remains largely invisible to the average person. Welcome to the world of BlackRock, a financial titan whose assets under management, dwarf the GDP of most nations, making it, by many measures, the single most powerful corporation on Earth. Forget governments, forget traditional oil barons. The true power in the 21st century often lies in the invisible management of capital, and BlackRock is the undisputed master of that domain. Our story begins not with a bang, but with a remarkably shrewd realization forged in the crucible of financial crisis. In 1988, Larry Fink, along with several partners, recognized a critical flaw in the nascent world of asset management: risk. Most firms were focused on chasing returns, but Fink understood that understanding and managing risk was the bedrock of long-term survival and true influence. This realization wasn't just a good business strategy, it was the seed of an empire. They started with just $25 million, operating under the radar, focused relentlessly on a then-novel concept: creating bond funds with meticulous, transparent risk management. They pioneered models that quantified market uncertainty, turning the chaotic nature of debt markets into a predictable, manageable equation. This initial focus on risk became their greatest competitive advantage, allowing them to grow steadily even when competitors stumbled. But to truly understand the scale of the hidden empire, we must first grasp the sheer magnitude of what they manage. We aren't talking about billions, we are talking about trillions, currently hovering near $10 trillion in assets under management. To put that staggering number into perspective, consider this: if BlackRock were a country, it would be the second largest economy globally, trailing only the United States. This capital isn't just sitting idle, it's invested, directed, and leveraged across the global economic landscape. Every major publicly traded company, from Apple to ExxonMobil, from Walmart to major pharmaceutical giants, has BlackRock listed among its very top shareholders. They are not merely a shareholder, often, they are the shareholder holding significant, often leading, stakes. This passive ownership structure is the first layer of the mystery. They don't usually run the company's day-to-day, but their sheer ownership grants them unparalleled influence over corporate governance, executive pay, mergers, acquisitions, and the very direction of environmental, social, and governance (ESG) policies that are reshaping global business practices. The narrative often shifts to their technological juggernaut, Aladdin. Aladdin, an acronym for Asset, Liability, and Debt and Derivative Investment Network, is BlackRock's proprietary software platform. It started as an internal risk management tool, but its power was too immense to keep locked away. Today, Aladdin is the silent nervous system for a significant portion of the world's financial plumbing. Major banks, pension funds, insurance companies, and even sovereign wealth funds, BlackRock's direct competitors, pay licensing fees to use Aladdin. This means that BlackRock has an unparalleled, real-time view into the balance sheets, the exposures, and the potential vulnerabilities of the entire global financial system. They see the interconnected web of debt and derivatives before anyone else. This technological moat creates a feedback loop. Their insights feed their investment decisions, and their investment decisions shape the market, which in turn validates their technology. It's a self-perpetuating cycle of data dominance. As we peel back the first layer of BlackRock's foundation, risk management expertise and technological supremacy, we begin to see the tools they use to build their massive footprint. But the real question remains: how did this mastery of risk translate into such sweeping, often invisible, control over the real economy? The next phase of our journey will explore the aggressive expansion strategy that saw them consume rivals and absorb vast asset pools, turning them from a bond specialist into a universal investment powerhouse, a transformation that involved one of the most consequential acquisitions in financial history, setting the stage for the global monolith we see today. The seeds sown in rigorous risk management quickly blossomed into a mandate for aggressive expansion. Larry Fink and his team understood that in the world of asset management, scale begets stability, and stability attracts even more capital. The turning point, the moment BlackRock truly began its ascent to near ubiquity, wasn't just organic growth. It was strategic, calculated absorption. The pivotal moment arrived in 2009, right in the churning, chaotic wake of the global financial crisis. Governments worldwide were scrambling to stabilize markets crippled by toxic mortgage-backed securities and frozen credit lines. Who did the U.S. Treasury Department and the Federal Reserve turn to for help in managing the fallout from failing financial institutions? They turned to the firm best equipped to analyze, value, and manage truly catastrophic risk, BlackRock. This emergency appointment, managing assets from failed entities like Bear Stearns and AIG, wasn't just a lucrative contract. It was an unparalleled masterclass in systemic fragility, giving BlackRock direct, intimate knowledge of the weakest links in the global financial chain. This hands-on, quasi-governmental role cemented their reputation as the ultimate crisis managers, a status that ironically made them even more indispensable. Following closely on the heels of this crisis experience came the seismic merger with Barclays Global Investors, BGI. In 2009, this acquisition wasn't just about adding zeros to the AUM column, it was about acquiring the crown jewel of passive investing, the iShares ETF platform. Before this merger, BlackRock was known for its active and customized bond strategies. BGI, and specifically iShares, gave them instant, unparalleled dominance in the low-cost, transparent world of exchange-traded funds. Suddenly, BlackRock wasn't just managing money for pensions and institutions, they were managing the investment vehicle of choice for millions of retail investors globally, further weaving their influence into the fabric of everyday savings. This move instantly created the largest ETF provider in the world, a position they have relentlessly defended, making the very act of modern, low-cost investing synonymous with the BlackRock brand, even if the investor doesn't realize it. The synergy was breathtaking. They controlled the analytical platform, Aladdin, they controlled the risk assessment framework, and now they controlled the primary delivery mechanism for passive global equity and bond exposure, iShares. This trifecta, data, analysis, and distribution, created a fortress around their business. But the empire building didn't stop there. The acquisition of Citigroup's alternative investment management business and subsequent moves further consolidated their power in areas previously reserved for elite hedge funds. They were systematically buying up capabilities, talent, and client mandates, transforming from a specialist into a generalist powerhouse capable of managing virtually any asset class for virtually any client type, from sovereign wealth funds to retail brokerage accounts. This consolidation is key to understanding the hidden empire narrative. When a handful of firms manage the majority of the world's investable capital, they effectively become stewards of global capitalism. They vote on everything. Their proxy voting record becomes a de facto policy-setting mechanism for thousands of companies. If BlackRock votes against a CEO's compensation package, that package is likely dead. If they champion a certain climate resolution, boardrooms across the globe take immediate notice. They wield the votes of trillions of dollars, and while they often claim a passive stance, the sheer weight of that vote exerts an active, directional force on corporate America and beyond. They are the ultimate universal owner, sitting at the table in every major boardroom, yet seldom speaking in a voice the public recognizes. This deep integration into the administrative side of capitalism, governance, stewardship, and systemic stability sets the stage for the next, even more subtle layer of their power, the transition from being just an asset manager to becoming a provider of infrastructure for the entire system, paving the way for the revolutionary and controversial concept of sustainable investing, which brings us closer to the direct impacts on Main Street. BlackRock's transformation into a universal owner, a firm so vast that it owns a slice of every major company, has profound, sometimes insidious, implications far beyond the simple movement of stock prices. The sheer breadth of their ownership means they can't simply divest from a sector, they must influence it. This is the new financial reality. One of the most tangible areas where their influence touches everyday life is the real estate market. While headlines often sensationalize BlackRock's direct ownership of single-family homes, their true power lies in their massive, multifaceted investment across the entire real estate spectrum: commercial property, residential rental portfolios, and critical infrastructure through specialized funds and REITs, real estate investment trusts. BlackRock's real estate strategies, often executed through private equity funds and partnerships, target long-term, inflation-protected assets. Their vast capital has been deployed to acquire stakes in logistics hubs, massive data centers, and multifamily housing complexes across the globe, fundamentally reshaping the availability and pricing of rental properties. When a $10 trillion behemoth allocates even a small percentage of its portfolio to a specific asset class, the price action is felt immediately, turning local housing dynamics into global capital plays. Their involvement in the rental market, driven by the search for stable, recurring revenue for their institutional clients, creates upward pressure on prices and rental rates, drawing a direct line between the decisions made in their Manhattan Tower and the rent paid by a family in Texas or Berlin. This financial footprint on the foundational element of personal wealth and stability, the home, is a critical, often debated aspect of the hidden empire. But no policy has been more defining or more controversial in recent years than the push for environmental, social, and governance (ESG) investing. CEO Larry Fink famously declared that climate risk is investment risk, positioning BlackRock at the forefront of the movement to integrate sustainability into corporate decision-making. Through their stewardship, the process of exercising their massive voting power, BlackRock demands better climate disclosures, board diversity, and improved human capital management from the companies they own. This has forced major corporations to set net zero targets and overhaul their supply chains. The ESG push is, in effect, BlackRock using its massive ownership stake to enforce a new set of values on global capitalism. However, this shift is fraught with paradox and controversy. On one side, they face accusations of greenwashing, investing billions in fossil fuel giants while simultaneously promoting sustainable funds. Critics argue that their engagement strategy is too lenient and that their vast index funds still hold massive stakes in the very polluters they claim to be pressuring. This dual role, part advocate for sustainability, part massive investor in the traditional energy complex, places them at the center of a cultural and political firestorm, drawing criticism from environmental activists for not moving fast enough, and from certain political factions for prioritizing woke capital over pure shareholder returns. The debate over ESG has become a battle for the soul of the company and a major risk factor, making them a political target. BlackRock is not just a custodian of capital. It has become a central planner for corporate behavior, dictating the terms of engagement for thousands of publicly traded companies through the invisible hand of the proxy vote. The question is no longer if they influence the market, but to what extent this consolidated power, this universal ownership, creates systemic risks, conflicts of interest, and an uncomfortable overlap between the goals of a private company and the function of a global economic regulator. As we proceed, we must ask, how does a firm with this much data and influence avoid becoming a single point of failure for the entire system? And what happens when the financial health of governments themselves becomes intertwined with the success of BlackRock's software platform? The answer lies in the next chapter, where we will examine the critical role they play as advisors to the very governments they regulate. The final and perhaps most concerning layer of BlackRock's power structure is its uncanny ability to operate seamlessly between private finance and public policy, a phenomenon often referred to as the revolving door. This isn't just about hiring a few former regulators. It's about a deeply integrated, symbiotic relationship with the highest echelons of global government and central banks. During moments of extreme financial distress, BlackRock transitions effortlessly from being a market participant to a crucial government advisor. We saw this not only in the 2008 crisis but also dramatically during the 2020 market turmoil. When the U.S. Federal Reserve initiated unprecedented market intervention programs, who did they hire to manage the purchase of distressed corporate and mortgage debt? They hired BlackRock's Financial Markets Advisory (FMA) division. This effectively put the world's largest asset manager in the unprecedented position of executing policy for the most powerful central bank. Think about the massive, inherent conflict of interest. BlackRock was advising the government on which assets to buy to stabilize the economy, while simultaneously managing funds that held or were interested in those exact assets. The information advantage gained by executing the Fed's debt purchase program, knowing the exact price points, quantities, and timing of central bank intervention is priceless. This is where the concept of the fourth branch of government gains traction. BlackRock doesn't make laws, but its deep advisory role to institutions like the US Treasury, the European Central Bank, and various sovereign wealth funds allows it to shape the implementation and structure of those laws, effectively making them a powerful, unelected shaper of global economic policy. Their former executives frequently step directly into top government roles, and conversely, former government officials step directly into high-paying, influential positions at BlackRock. This constant interchange ensures that BlackRock's perspective, the voice of the universal owner, is always present at the table where the rules of global finance are written. It is a brilliant, entirely legal strategy to minimize regulatory risk. They don't have to fight regulation if they help write it. This systemic integration elevates BlackRock from simply an investment firm to a pillar of the financial infrastructure itself, creating a significant and ongoing debate about systemic risk. Is a company that is so intricately woven into the fabric of global finance, and which sees the balance sheets of its competitors and governments through the Aladdin platform, too big to fail? Regulators have traditionally focused on banks as sources of systemic risk, but critics argue that a firm like BlackRock, whose failure could destabilize billions of individual retirement funds, cause a mass exodus from ETFs, and cripple the Aladdin-dependent risk systems of hundreds of other institutions, poses a unique and possibly larger threat. Because BlackRock does not leverage itself like a traditional bank, it manages client money, it doesn't primarily borrow it. It has largely avoided the strict regulatory scrutiny applied to systemically important financial institutions, or SIFIs. Yet, the operational failure of Aladdin, or a massive, coordinated sell-off across their passive funds, could trigger a cascade effect across global markets. The threat is not one of insolvency, but of liquidity and operational chaos. This hidden risk makes their constant advisory role to governments even more critical and, to some, more alarming. They are both the system's primary custodian and its de facto crisis manager. In the next part, we will pivot to the hidden clients and the sources of the $10 trillion, uncovering where the money truly comes from and how this passive, nearly invisible model extracts value from the deepest pockets on Earth, linking the smallest pension saver to the largest state fund. To truly grasp the scale of the BlackRock phenomenon, we must look not just at what they own, but whose money they manage. The $10 trillion under their control doesn't belong to BlackRock. It belongs to a vast, invisible army of clients who represent the deepest pools of capital on the planet. This is the ultimate hidden layer of the empire, the silent clients. The bulk of BlackRock's assets come from pension funds, both public and private, managing the retirement savings of millions of teachers, firefighters, and municipal workers worldwide. They manage the assets of massive sovereign wealth funds, state-owned investment funds from nations rich in natural resources, giving BlackRock a direct line to the financial strategies of foreign governments. And, of course, they manage money for insurance companies, endowments, and nearly every major financial institution on Earth. This means that BlackRock is the steward of the global social contract, the stability of your local pension, the security of a nation's reserve wealth, and the reliability of insurance payouts are all, in part, resting on the decisions made by Larry Fink's firm. Their relationship with these clients is where the genius of the iShares ETF model truly shines. Exchange-traded funds, ETFs, particularly the passively managed index funds that form the core of iShares, are brilliantly simple. They track an index, like the S&P 500, at an incredibly low cost. This low fee structure is what attracts the massive, sticky capital of pension funds. But this simplicity masks a monumental mechanism for value extraction. BlackRock's revenue is not derived from flashy, high-fee stock picking. It's an industrial-scale operation based on an exponential volume of tiny fees. Imagine a fraction of a percentage point, say 0.03%, charged on $10 trillion. That minute fraction explodes into billions in predictable, recurring annual revenue. It is the ultimate high-volume, low-margin business executed at a scale that generates staggering profits. It's like owning the toll booth on every single road in the global economy. This passive approach, however, has a controversial side effect. Critics argue that when the majority of capital is managed passively, firms like BlackRock simply pump money into the biggest companies, regardless of their actual prospects or innovation. They are an engine that rewards size over substance, potentially dampening competition and starving smaller, more dynamic companies of investment capital, a condition known as common ownership. Furthermore, there's the hidden revenue stream, securities lending. BlackRock loans out the shares held in its passive funds to other firms, typically hedge funds, who want to short the stock, bet against it. BlackRock then takes a cut of the profit from this lending activity. This is money generated directly from assets that technically belong to their clients, your retirement fund, and it adds hundreds of millions, often secretly, to BlackRock's bottom line, further blurring the line between passive stewardship and active market influence. The empire thrives by being the ultimate middleman, facilitating every type of financial transaction, from safe pension investment to speculative short selling, and taking a small, steady cut from all of it. This mastery of the fee structure and the quiet absorption of trillions in retirement savings ensures not just profitability, but permanent, systemic entrenchment. But this centralization of control has led to an inevitable pushback, a global search for alternatives and a renewed focus on the geopolitical implications of putting so much capital in one place. In the next chapter, we will reveal the counterforces arrayed against the hidden empire and the critical, future debates about decentralization and financial sovereignty. BlackRock may be the most visible face of the hidden empire, but it is not alone. Its dominance is challenged, or perhaps more accurately, mirrored, by two other colossal asset managers, Vanguard and State Street. Together, this Big Three collectively holds significant stakes in nearly 90% of S&P 500 companies. While they often operate under different business models, Vanguard is structured as a client-owned mutual company, and State Street is known for its custodial services and SPDR ETFs. Their combined power ensures that the voice of the universal owner trio dictates the terms of modern corporate life. Any major corporate action, from a hostile takeover defense to a climate resolution, must first pass the scrutiny of these three giants, who often vote in concert, amplifying their influence exponentially. Their competition, however, drives the relentless race to the bottom on fees, a boon for the everyday saver but a systemic force that further concentrates power in their passive, highly efficient index funds. The empire, however, faces threats not just from rivals but from the volatile landscape of geopolitics. BlackRock's operations in China, its investments in critical global infrastructure, and its vocal stance on ESG have made it a lightning rod for political scrutiny. Nations are increasingly viewing asset management as a tool of statecraft. BlackRock's attempts to navigate the strategic competition between the US and China, for instance, launching funds in China while simultaneously commenting on the risks inherent in Chinese assets, have placed it in the crosshairs of both Washington and Beijing. When a firm is this large, its investment decisions are no longer purely financial. They are seen as acts of geopolitical alignment. This scrutiny is part of a broader global trend of financial sovereignty, where governments seek to exert greater control over national capital flows and reduce reliance on behemoths seen as foreign or unaccountable. This fragmentation challenges BlackRock's core ethos of seamless global capital flows. But the biggest long-term disruption to the hidden empire may not come from rival firms or hostile governments. It may emerge from technology itself, specifically the concept of decentralized finance or DeFi. The core premise of BlackRock's power is its role as the trusted middleman, managing risk and holding custody of assets. Decentralized technologies such as blockchain and tokenization promise a future where assets are held and transferred peer-to-peer, without the need for a central custodian. If capital can be efficiently managed and traded directly on a digital ledger, the need for a massive, multi-trillion-dollar intermediary like BlackRock could theoretically diminish. However, BlackRock's response has been characteristically shrewd. Rather than fighting the revolution, they are attempting to co-opt it. By moving aggressively into products like Bitcoin ETFs and exploring the tokenization of traditional assets, they are essentially taking decentralized concepts and packaging them within their heavily regulated, trusted infrastructure. They are applying their institutional power, their regulatory access, and their technological prowess to bridge the gap between traditional finance, TradFi, and the digital future. The ultimate question is whether they can successfully integrate the decentralized future into their centralized empire, or whether the forces of true digital disruption will eventually erode the very foundations of their power, leading to a profound shift in who truly controls the global financial system. This relentless tension between centralization and decentralization, control and chaos, will define the final trajectory of the hidden empire. We have traced the remarkable journey of BlackRock, from a modest risk management startup to the architect of modern finance. From crisis consultant to the ultimate universal owner whose technological nervous system, Aladdin, sees everything. The story of BlackRock is not merely a tale of massive wealth. It is the definitive narrative of the 21st century economy, demonstrating how passive capital, microfees, and an unparalleled network of political influence can create an empire that touches every facet of global life, from the cost of your mortgage to the environmental policy of the world's largest corporations. The empire's strength lies in its essential, almost invisible nature. It is the plumbing of global finance, and like any utility, its constant, low-cost presence makes it indispensable. They are the market, the infrastructure, and increasingly, the advisory board to the very governments responsible for their regulation. They successfully bridge the gap between institutional money, the trillions held by pension funds and sovereign wealth, and the low-cost ETF model, effectively democratizing market access while simultaneously centralizing control over corporate governance within the hands of the Big Three. The final, defining theme of this hidden empire is the profound, systemic trade-off it presents to the world. The efficiency is undeniable. Millions of savers benefit from low-cost retirement investing, and the global financial system has a sophisticated, albeit highly centralized, risk management tool in Aladdin. However, the costs are substantial. The risk of concentration of power, the inherent conflict of interest in advising central banks while simultaneously being a market participant, and the blurring of lines between market logic and political mandate. BlackRock's ESG push, for all its controversy, is a microcosm of this power, a private firm setting public policy for thousands of companies based on the massive collective voting power of global retirement savings, determining which sectors receive capital and which are starved. The future of the financial world is now less a battle between active and passive investing, and more a philosophical struggle between centralization and decentralization. BlackRock, with its strategic embrace of digital assets and tokenization, is signaling its intention to integrate the digital future, not be destroyed by it, ensuring the centralized middleman remains necessary even if the assets themselves live on a blockchain. The hidden empire has been revealed. It is not an evil organization operating in a vacuum, but rather a hyper-efficient, highly complex, and utterly enormous financial entity that arose from the legitimate demand for efficient risk management and low-cost investment. Its success is a testament to the power of scale and data dominance, and its existence forces the world to confront fundamental questions about economic democracy and accountability. We must now ask ourselves, as both investors and citizens, is this concentration of power an unfortunate necessity for global stability, or a systemic risk waiting to explode? Who truly holds the leash of the world's financial watchdog? And when a single company owns a piece of nearly everything, does free market capitalism still truly exist, or have we entered the age of the unchallenged universal owner? The answer to those questions, and the future of global capital, ultimately lies not in the decisions made in the boardrooms of BlackRock, but in the policy choices made by the governments and the investors who rely on its hidden empire. End of prompts and story.